Hi everyone, and welcome to today's video lesson for Profit Stacker. This is, of course, lesson one, and this video is being brought to you by Trade Partner. Now, if you've not looked into Trade Partner will absolutely help you execute the Profit Stacker strategy on the most efficient way or the most efficient way that you can possibly execute it because it allows you to do so, plan the whole trade and walk away from the computer screen. You do not have to be in front of the computer screen. In fact, last week's trade, I placed on, and then I had to get on the plane. And by the time I got off the plane, it had already gone through a couple of sequences of different orders, and basically guaranteed $100 on the trade. So it's tremendous help. I will have a video on Trade Partner that will be an addendum to the Profit Stacker lesson so that you can see how I use Trade Partner to execute this strategy in the most efficient possible way. So today's lesson, I'm going to focus on the core trade. And I'm not going to get into a lot of details with regard to a lot of variations. I'm not going to talk about steps 2 and 3. I'm going to try and keep it as simple as possible so that you understand the concept and what we're trying to do here. Because really, that's the important thing: is to understand the concept, also to understand some of the traps that exist with this particular approach. So I'm gonna keep it with focused on the core trade, but I want you to understand that it is not limited. The core trade, what I talk about today, is not limited to what I'm going to be talking about. There are many different variations. So what I want to do is I want to give you a couple of 3 different blueprints for creating a core trade. It is not, none of these are absolute. They're just a solid basis by which you can kind of gauge other possible core trades as you move forward and gain in your understanding of this approach. Okay. Now, there is one main purpose of the core trade. You cannot let this slide by. And I'll talk more about this at the end of the lesson, but there's one main purpose of the core trade. You need to keep that main purpose in your mind at all times when you're looking at the core trade and you're about to place the core trade. And that is, the purpose of the core trade is to create an environment to profit from short option trades where the risks are absolutely limited. That's all we're doing. We are setting up the potential to profit from short option trades while keeping the risks absolutely limited, and also setting it up so that we have a very high probability of success. And so this is the purpose. And there are several different ways to profit from short option trades. Number one, time decay. That's one way that we profit from it. And number 2 is market movement. And you can skew every single profit stacker trade to one or the other, or you can kind of give it a balanced, if the market moves, I'll make money. If the market doesn't move, I'll make money type stuff. Or you can say I'll make a lot more money if the market moves back and forth. You can actually skew it for that, but that's more involved with lessons 2 and 3, and even 4 to some degree. I'll briefly touch on some of that today, but this is very important that you keep this purpose in mind, because you're not putting on the core trade to just stick with the core trade until the end and be done. If you want to do that, there are other strategies that are probably better suited for that. But if you do that with this one, the probabilities aren't, while they're still in your favor, that's not the purpose of Profit Stacker. So just want to make sure that that's absolutely clear. So when you understand that this is the purpose of the core trade, believe me, the rest will fall into place rather easily. It makes sense when you start getting to step 2 and step 3, which, by the way, if you haven't had the opportunity or taken the time to look at the quick start guide or the quick start reference guide that I've provided, I would absolutely do that, because it gives you a quick idea of where we're going with this approach. You can also take a look at weekly reports. Obviously, that will give you a good idea of not only where we're going with these, but also how it is implemented. Okay, here's where it begins. The core trade is a diagonal spread where the longs expire after the shorts. Okay, so that's the first piece of the core trade. It's always a diagonal spread. It's never an absolute credit spread. And there are many reasons for that. I don't want to go into those reasons in this video because I cover the principles that kind of drive the reason why diagonal spreads are more efficient as a general rule than just credit spreads. But that's where the core trade starts. It starts where the long expires after the short. And this generally consists of a weighted spread or more than a one-to-one spread. Okay, so for example, there'll be two longs and two shorts in a diagonal spread, or there'll be three longs and two shorts, or there'll be four longs and three shorts, or it can also consist of three longs, two short, one short, or even one short, two longs, all right, or some other variant. So again, there are many, many different ways to put the core trade together. I'm going to give you three basic ways, and I'm going to give you the blueprint for those three ways, so that you're not stuck, putting together, 100 different possible core trades and trying to figure out which one you want to put together. Don't overthink this. And one reason that you don't want to overthink this is because the core trade is not the end purpose of the core trade. So if you overthink it, you'll find yourself paralyzed and not able to make any decision because there's just too many combinations out there. That can absolutely be presented as a valid core trade for this approach. These are not the only ones, but I want to give you a starting point so you don't get too convoluted with all the different combinations that are out there. And the third thing is that the shorts, there are never, ever, 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 ever more shorts than there are longs. Okay, never more shorts than there are longs. At that point, you become naked a short, and we do not want to do that. Sometimes there's an equal amount of longs and shorts, but even in the processes of steps 2 and 3, we never create a scenario where there's more shorts than there are longs. So absolutely key for you to remember this. Now, generally, what we're going to be doing is we're going to be putting together a Friday-Monday diagonal. The shorts will expire on Friday. The longs will expire on Monday. That does not mean, again, that you can't do Monday, Wednesday, or Wednesday, Friday. You absolutely can. Maybe eventually I'll throw together, a weekly report, or in one of the weekly reports, I'll throw together some examples of that. There are benefits to not doing Friday, Monday, and I will get into that later. But then there's also cons to doing Monday, Wednesday, or Wednesday, Friday, right? So you just kind of have to weigh which ones you want to move forward with. I generally stick with Friday, Monday, and again, as we go through this, I'll touch more on that. And then finally, we always create a credit, and oftentimes it's a big credit. And so that's part of what sets up the core trade to accomplish our end goal or our purpose with this whole strategy in the first place. Always creates a credit. All right, so generally consists of 2-2, 3-2, or 4-3. I'm not going to even go into the 4-3. In fact, I'm going to replace the 4-3 with a 3-2-1 by the end of this lesson, but I leave it in there just to show you that it is possible to do a 4-3 trade. But I'm gonna have you steer away from it to begin with. In the weekly reports, you'll see every now and again a 4-3 trade, and you can use that to glean, what I do with a 4-3 trade, or why I might do a 4-3 trade. But as a general rule, I'm gonna try and steer you away from those, just simply because they tend to be a little bit more risk, and you can simplify it. And I'm always for trying to simplify it if you possibly can. And in fact, if any of this is confusing by the end of this, I would look at simplifying this even further. And instead of doing a 2-2 trade, maybe a 2-1 trade, or maybe even you just simply buy an option to begin with, and then you go through steps 2 and 3. based on that one single loan option, because the risk is going to be there. The problem though is that you're not creating a credit. Whenever you buy a single option, you're creating a debit, and if the market tanks, you're going to lose that money, right? So it's not the ideal situation, but if you want to really simplify it, it's something that you can at least even look at to see how this process works. Okay, so here is an example of a 3-2. This is the one I'm going to focus on to begin with, and this is a great one to start with. It's not, again, the necessarily the best every single week, but it's a solid one to start with. And so here is a short 2 SPY September 7th, 286 calls, long 3 SPY September 10th, 289 calls for a net credit of 310. And if you didn't gather by now, the only place that we can trade this approach is in SPY, because it's the only one that has Friday, Monday expiration. So I know that sometimes is a given, sometimes it's not a given, depending on your understanding and knowledge of the weekly options. Only SPY has Monday, Wednesday, Friday option expiration right now. This is an actual trade example taken about a year ago, and just to show you that this is something that has been around since the Monday option came on board about a year ago, actually a little more than a year ago now. And I've seen enough. I've seen, obviously there's no history of Monday options prior to Monday options actually coming on board. And so it took me a little bit of time of watching to make sure I understood how the Monday expiration would react to price action and to the weekend, and et cetera, et cetera. And I think I have enough experience where I can definitely help improve the overall efficiency of how these are traded because of that. But I did start taking some of these trades as long as a year ago, and with this particular version, you can see that the profit potential is $300 to the downside, and the risk is about $100 to the upside. You'll also notice that there's a 3-point strike difference between the short and the long. Okay, that is to begin with. There's no reason to move away from that strike difference. While you're learning the approach, you absolutely can move away. You can do a 1-point strike difference, a 2-point strike difference, a 3.5 strike difference, et cetera, but not until you understand the principles behind this and you experience some of this working, et cetera. Keep it simple, keep it at 3 points. And then with this particular example, it is a 310 credit where the long is slightly out of the money. And this is a solid blueprint for how you can put these trades on in the future. And so that's the example. And here is the different details of the blueprint of this 3-2 trade. Again, 3-point strike difference. The long is slightly out of the money. It could be at the money, or maybe even slightly in the money. So I just wouldn't venture away from that too much to begin with. The shorts are in the money by less than 3 points, and that's in this example. Again, it might be at the money, might be slightly in the money, but you get the idea. And then the credit needs to be around 250 or better as a general rule. And 250, if you're working with a 250 credit, you need to understand that you are going to need to be aggressive with step 2 and step 3, because 250 is not the best credit in the world for this particular setup. And as you can see, this is a 310 credit. And so this particular 310 credit, that's a better price than a 250 credit by $60. Meaning if I got into this trade with a 250 credit, then the projected loss is about $150 if I do nothing. And that's a pretty high probability of seeing some sort of loss. Now, this trade alone, the probability is absolutely in your favor. A, because the market doesn't necessarily have to go anywhere in order for this to make money, but if it moves up, then that's where the risk is, and that's in the dead zone. And I'll get to that here in a second. Nonetheless, I just realized that I misspoke when I said the short is 3 points or is less than 3 points in the money. I said it could be at the money or slightly out of the money. I'm sorry, I meant to say that it could be slightly in the money by 3 points, or right at 3 points in the money, or slightly less than 3 points in the money. All three in the money, obviously. If hopefully I didn't confuse you too bad on that. Nonetheless, again, the credit needs to be around 250, and we're looking at Friday short, Monday long combinations. Now, this trade is probably not going to line up until around Tuesday before the Friday expiration. Okay, if you try to put this trade on 2 weeks out, not going to work. If you try and put this trade on Friday morning, day of expiration, it may work. In fact, I've done it before, but you're giving yourself very, very little time for the market to move. And so what we want to do is we want to have a balance of time decay and market movement. And the sooner we're able to get in, the higher the probability is we're going to be able to do something with the trade to stack the profits. All right, so generally, starting around Tuesday or Wednesday, you're going to be able to start to see these opportunities present themselves. Now, I will also say this, that if you put this thing on a Tuesday at a credit of 250 and the market goes nowhere, on Wednesday, you're probably going to be able to get it for 260 or 270 on Wednesday. And if you put it on for 260 or 270 on Wednesday and the market goes nowhere, you'll probably be able to put it on for 280 or 290 on Thursday. So this is something where the price does get better as it's getting closer to the expiration. You're not going to get the best price on this thing. That's where the risk comes from, right? Is the price is getting a little bit better, and that's creating a little bit bigger risk for getting in earlier. Okay. However, again, it's a balance. Best priced, more time for the market to move and give me an opportunity to stack profits. And that's what you have to balance. All right. So with this particular example, the purpose of this, and again, I'm going to mainly cover this in a future lesson, but the purpose is to exit one of the shorts in the short leg if the market moves down. And or I'm going to add a short, a different strike obviously, if the market moves up. Right? That is where steps 2 and 3 come in. And so you have to keep in mind that the purpose of step 1 is to proceed to step 2 and step 3 as often as the market will allow. Now, again, technically you can get the credit on Monday, Wednesday, or Wednesday and Friday. Everything should work the same when you get to steps 2 and steps 3. However, the problem is that you need at least 2 days for the market to move to give you a solid balance. So if you get it on Tuesday or Wednesday, maybe even Thursday morning at the latest will give you a solid probability of seeing the market move enough. Same thing with the Monday and Wednesday or Wednesday and Friday. But again, I don't want to get into that too much. Just be aware that it does exist. Now, the biggest issue with a 3-2 trade is what I call the dead zone. And this dead zone is where the risk is. And the risk in this particular dead zone actually has a fairly high probability of seeing the market move into this dead zone throughout the life of the trade, about a 55% probability, as a matter of fact, which means that you have about a 55% probability of realizing a loss if you don't do anything else with this particular trade. So you have to be very careful with this, and I will explore this a little bit more as we move forward. But the market tends to move up slightly, especially if you're talking about only a few days. And if there's not enough time left, you won't be able to bring in any time value on any added shorts or exiting one of the existing shorts, which will increase your chances of realizing some risk. All right, so this is why I say you need to be aware that the purpose of this is to go to step 2 and step 3, if at all possible in this scenario, especially the later in the week that you get into the trade. But by getting into the trade on Tuesday before the Friday expiration, what that means is that you have 3 full days that are available for the market to make some sort of movement, either into the dead zone. And what we're going to do is, if the market moves into the dead zone, we're then going to add a short option. And that will push the risk to the upside, which you will see later on. And if the market moves down, we're going to exit one of the shorts at a profit, which will then change this dead zone, maybe even create a risk-free projection trade. So the more time you have for the market to make a move, the greater the probability that the risk can be dramatically reduced on the trade, if not eliminated. Now, again, one of the things that reduces the risk is just simply getting a better price as well. And that's why I have in the past, in testing this thing, have placed the trade on a Friday morning. The market moved. I was able to exit at a profit, but I got a really good price for the spread. Market moved. I was able to exit one of the shorts at a profit and create like a $50, $75 trade in one day, and the potential for much bigger if the market made a bigger move, right? So it's important for you to understand these principles that are at work as you are putting on the trade, so you know how to plan the trade out. So why not go out 2 weeks and really build the profit? Obviously, if you go out 2 weeks, the market can move back and forth a lot in that 2-week period, right? Well, this is one of the reasons, because that same spread that I just showed you that expires in 3 days at the time that it was placed, if I were to take that same spread only the week before, I only get like a 70-cent credit. And that 70-cent credit creates a scenario where my risk in the dead zone is $200, which means that I'm going to have to do quite a bit to eliminate that $200 risk. I'm going to have the market move quite a bit, and my options, if you will, are limited for doing that, because I cannot get rid of one of the shorts. If I get rid of one of the shorts in this example, I create a debit, or I create risk to the downside, and it can be substantial. So this is why there's a sweet spot timing-wise of when you want to start looking at placing on the core trades. All right, so that is a 3-2 blueprint, and you can start with that. And obviously, if you can get your first trade, if you can get a 280, 290 credit, then you have a little bit less risk. As long as you've got enough time for the market to make some sort of move, you increase the probability of being able to diminish that risk dramatically, if not eliminate it altogether. So that's a 3-2. Let's drop it back down now and take a look at a 2-2 trade, a 2 longs, 2 shorts trade, and what that looks like. Now, generally, why would I want to put on a 2-2 trade? Well, if the market has just made a big move up, then basically what I'm doing is I'm creating a little bit more bearish leaning trade. And by doing that, again, the chances of being able to dramatically reduce the risk increase dramatically when the market moves down, because once it moves down, I don't have to cover 3 longs. I only have 2 longs. And so if I get rid of one of the shorts, I now have a 1-2 trade. It can actually be quite beneficial in those scenarios, because you create a bigger profit potential. And so I look for these opportunities after the market has made a big move to the upside, because I have an increased probability of seeing a retracement. So here's the blueprint for the 2-2. Again, I'm gonna be fairly straightforward in how this is presented. It's not always like this exactly. There are different variations, but this is a solid blueprint to start from. Short is generally in the money by 3 to 4 points, and I would not go much more than 4 points. But it's generally in the money by 3 to 4 points. The long is 3 points above the short, so the same as the 3-2. And then the total credit must be above 2 points per spread, per 1-1. So if I have a 2-2, then it needs to be a minimum credit of 4 points. Okay, that is the general blueprint for creating a 2-2. And you might notice that really all we're doing is we're dropping that third long with regard to the blueprint. Instead of doing a 3-2, the whole thing is almost exactly the same, except for doing a 2-2. And this is what that looks like. And in this example, it is a 442 credit. And the risk is the strike difference minus the credit. Okay, strike difference minus the credit. And I'll discuss this more in the 3-2-1 setup that I will talk about here in a few minutes as well. But the risk is the strike difference minus the credit. So the strike difference is $3. The credit is $2.21 each, which means on this trade I have a $79 risk on each spread, and of course I have two of them. It's a 2-2. And so my total risk is $158. And that's going to happen somewhere up to the upside. Now, if I have a $4 credit, what that means is that I'm risking $200 to the upside. $200 to the upside. So I'm going to be really cautious with you guys about placing these on, and I'm going to encourage you to be cautious and encourage you to do something better than a $4 credit if you're going to place some of these on, so that you're not risking $200 in one shot. There's no reason for it. There are ways to diminish that, but in this example, it's a $158 risk, and that's kind of around where my limit is, between $160 and $170, depending on how much time is left and depending on whether I have the opportunity to diminish the maximum risk or not. One of the reasons, again, that I only look at this generally after the market has made a big move up is because it does carry a bigger risk. Okay, so the goal, again, with the 2-2 is either to make it a 2-1 by exiting one of the shorts, or by making it a 3-2 by adding a long at a better price than the original long, or at different strikes. So in this particular example, it is a 296 call and a 299 call, same as the first example. The 296 call is long from 382, or excuse me, short from 382. The 299 call is long from 161. So, step two is going to say, all right, either I'm going to exit one of my shorts, or I'm going to add a long, and I can add a 299 long for $1, for example. Instead of buying all three longs at $1.61, I buy one at $1. And a couple of things can make that happen. Time can pass and lower the price of the call, or the market can move and lower the price of the call. Again, I don't want to get into that in detail. I just want to give you kind of a heads up of where we're going with a 2-2 and what the purpose is. In a 2-2, again, the long needs to be at the money or slightly in the money as a general rule. And the further in the money it is, the lower your risk is going to be, but the closer it's going to be. All right, so the market's not going to have to move up quite as much to hit that risk if it's further in the money. Again, you'll see that kind of borne out. But more importantly, and this is kind of where we start to get into some of the details of why the numbers need to be what they need to be. But more importantly, the credit needs to be more than the cost of the short option. All right, and you can very quickly take a gander at the price of the options and know whether that is the case. And it will be the case in most of these. All right, so it shouldn't be a problem, but I do want to at least mention it in this. The cost of the short needs to be, or excuse me, the credit needs to be more than the cost of the short. So in this example, the credit on a 2-2, the credit is 442, while the short leg is $3.82 on one of them. All right, and the reason for that is because if I then exit one of my shorts, it doesn't matter where I exit, as long as it's at a profit, I still have a credit. All right, and that's where this becomes important. It does not require any certain amount of profit to exit that first short at a profit in order to maintain a credit. I will maintain a credit. In fact, I could actually exit it at a loss and still maintain a credit. Of course, you don't want to do that under any circumstances, but just goes to show. So in other words, if I were to just place on this as a 1-2, one quick, very quick way of being able to tell whether that's the case or not. If I were to put this on as a 1-2, one short against two longs, it would still be a credit of 60 in this example. If I put on that 1-2 trade and it's a debit, then I already know I can't place a 2-2. Think about that for a little bit as you're looking for these 2-2s, and just kind of make it second nature to know that if you place on a 2-2, the credit has to be bigger than what one of the short options costs. This guarantees that we can exit the short at any profit. And so here's the 1-2 at a 60 credit. All right, you'll notice it is very similar. You've got the dead zone. It's very similar to the 3-2. The difference in this one is that the market is actually to the right of the dead zone, whereas in our 3-2 setup, the market is to the left of the dead zone. All right, with this particular 1-2 setup, it's to the right of the dead zone, which means, well, I'm not going to get into that. Well, I'll talk about step 2 in the next lesson. It's very easy for me to just go through the whole thing, but I want to make sure that we cover this properly and that you understand the dynamics and the principles of what's going on. So we want to maintain a credit. That's the purpose. Okay, so if I exit one of the shorts, I want to still have a credit so that I don't lose money if the market tanks. And I'll discuss this exiting and adding again more in lessons 2 and 3. So here is the core trade blueprint for the 2-2. 3-point strike difference. Long is at the money or slightly in the money. The shorts are in the money by about 3 points. The credit needs to be bigger than the cost of the short option. The credit should be around 220 per spread, an absolute minimum of 2, but I'm going to suggest that you go with 220 per spread. Obviously, we're going to stick with the Friday short, Monday long, and then again, this is probably not going to line up until around Tuesday. Sometimes you get a Monday bull move and a Tuesday bull move, and that's a perfect time to look at this possibility with this particular trade, is that around the close of Tuesday, if the market has made 2 days significant move 2 days in a row. So now let's move on to the 3-2-1 core trade. The 3-2-1 core trade is very similar to the 3-2 trade, only instead of taking away a long, we're actually going to add a short. So with the 2-2 trade, we take away a long. With the 3-2-1 trade, we just simply add a short to the core trade. And so this is the general blueprint with several minor variations, and it's very similar to the 3-2 and to the 2-2, save for the difference that I just explained. So in this example, we're going to be long 3 Monday expiration at the money or close to at the money strikes. We're going to be short 2 Friday expiration options that are 3 points below the long strike. So that's going to be about 3 points in the money. So very similar to the 3-2 trade. Difference is we're going to add 1 Friday short expiration that is 1 point above the long strike. So it's going to be out of the money by 1 point. That's the general blueprint and a solid beginning core trade, 3-2-1 core trade for this particular setup. Now there are several reasons for and several benefits for doing a 3-2-1 core trade. Number one, you lower the overall risks of the 2-2 trade. Okay, so that's the first major benefit. If the 2-2 trade is at $150, you're going to be able to lower that risk as a general rule below the $150. Second of all, it pushes the overall risks of the 3-2 trade, which are about $100, right, in the example that I gave. But it pushes those overall risks further to the upside, making them lower probability of actually occurring. All right, and then finally, and probably one of the more important aspects of this, is that it allows for more aggressive exit on one of the in the money short options. In other words, it benefits step two. So I'm not going to get into that, into the mechanics of that, but just understand that that's one of the major benefits of doing a 3-2-1 core trade. The drawback with a 3-2-1 core trade is that sometimes it's not available, and there's a sweet spot timing wise, and I'll touch on that here in a second. But this is the exact blueprint formula of what it looks like at a credit of 4. Okay, the maximum risk on this is $100, and that only occurs to the upside. The market has to move up at around the 303 or above area in order for that maximum risk to occur. And then obviously, if I do nothing else with the trade, right? So that's the maximum risk. It is not negotiable. It doesn't change. It is what it is because of the relationship between the strikes and the credit, which I'll get to. Okay, so the particular details behind this particular trade, it's short 2 Friday 297.50 calls from 305. We're long 3 Monday expiration 300.50 strike calls from 95 cents. So that gives us our 3-point strike difference between the 2 and the 3. And then 1 strike above the long, we're going to sell another Friday expiration. So we're going to sell the 301.50 call from, that'll be from 75 cents. The whole thing is a credit of $4. And that's, I would consider a lower credit, but that's a solid target goal for trying to get on a 3-2-1 trade. You're not always going to be able to do it. It's not always going to be available. But that's kind of that's the solid solid makeup of this. Now you'll notice here that the risk, there is a little bit of risk if the market goes nowhere. It's very, very small. There is a little bit of risk if the market moves up a little bit, but it's not $100. And in fact, it doesn't start to approach $100 until you start to get to the 303.50, 304 area. All right, so it pushes the risk to the upside. As long as you've got this credit, pushes the risk to the upside over a standard 3-3 call. So here's how you determine what that risk is, and this is why the risk is $100. The risk equals the total strike difference minus the credit, always in these trades. Total strike difference minus the credit. So let's just go through this real quick. The strike difference between the shorts and the longs, the first short and the long, is 3 points, right? So it's 300.50 minus 297.50, and we're in 2 of those. And so you multiply that, and that equals a total spread difference of 6 points. Then we subtract the next short from the long. So we are long from 300.50 minus the third short is 301.50. And obviously we're only in one of those, and the spread difference there is negative $1. And so 6 minus negative $1, negative $1. So 6 minus $1 is $5. That's the total strike difference in this spread between the longs and the shorts. And our credit is $4. So it's the total strike difference, which is 5, minus the total credit, which is 4, equals the total risk, which is 1. I know I've gone over this in a lot of my other videos, but if this is the first one that you're watching where I explain all this stuff, this is how you understand, how these relationships work, and why the risks are what they are, and why they're limited, and et cetera, et cetera. Okay, so it's very useful information for understanding how these spreads work. Now, if the credit in this scenario is 350, guess what the risk is? You automatically know from the beginning the risk is at $1.50. Right? You don't have to have a risk graph to tell you that. And so, that's again one of the benefits of understanding the relationships, because you don't need the risk graph to tell you what is going on. Now, I mentioned earlier that time-wise, there's a sweet spot when these are available at an acceptable credit. Again, if you get in too soon, you're not going to get the credit that you want. If you get in too late, you're probably not going to get the credit you want, because it all depends on, if you're getting in later, it depends on whether this call that is out of the money by 1 point is worth anything, right? And so there's at one point, if you get in too soon, everything is priced, the longs are too expensive. But if you get in too late, then this last short is not going to bring in enough money to create the credit that you're wanting. All right. So again, this is usually going to present itself starting on around a Tuesday if it presents itself. Sometimes the 321 is not available, but usually starting on around Tuesday and maybe as late as Thursday morning, you'll be able to get enough for that 301.50 call in this example to bump up that credit to an acceptable level. And again, why would I want to do this on a Thursday as opposed to a Tuesday? Well, if the market moves up on Tuesday and then again on Wednesday, man, I'm going to possibly be looking for this trade on a Thursday at a really good price. That gives you a rundown of the three basic core trades, and you know there's not a lot of difference between them, but you do need to understand what the ramifications are of those differences are. That's the starting point. Again, as you go through the weekly reports, as you go through some of the trade signals, you'll see maybe some variations of these, and you'll start to certainly build on this understanding. Now, there are some cautions and some risks that you need to be aware of when you're placing on trades like this, because not knowing these can cause you to go into some very ill-advised trades thinking that you're going to be fine. And I could tell you a horror story of someone who ignored what I said, thought they were only risking like $50, and they ended up losing $450. So you want to pay attention to what I'm about to tell you. All right. There's a principle, and it's a complaint that I've had for a long time. None of the option pricing models takes this into account. Okay. Especially since we're talking about Monday options that expire the day after a weekend, which makes it even worse. So none of the mathematical models that are used to project the value of these Monday options of what they're going to be worth on Friday, because we're going to exit all of these trades on Friday. And so we're relying on a projection model to tell us, okay, what are we going to be able to exit the longs at since we're exiting a day early? None of the models take this into account. So here's the principle of how this works. As SPY moves higher, volatility decreases out of the longs, which means that the risk projections through the upside in a dead zone can be wrong. And the more longs you have, the more wrong it can be. And so you have to understand that this is the case. And I'm going to show you how to diminish the risks of this, give you a couple of pointers, again, things that will help the efficiency of this approach. So what that means is that the projection here is that there's less than $100 risk at the worst case scenario if the market moves up to 290 in this example, and I do nothing. I can't do anything to diminish the risk, push it to the upside, et cetera, et cetera. I'm just stuck. And it moves up to 290. It doesn't fill me on anything else, and it just sits there and it dies. Until I exit the trade. Well, the more longs I have, the greater the degree of error that I have to account for in this dead zone. What if it's wrong? What happens if it's wrong? Well, it means that I might actually be risking, instead of, let's say, $90, I might actually be risking $125. All right. And if I have a lot of longs on compared to the number of shorts, I might be risking even more. And I've had traders that come in here and they say, oh, wow, look at this. I can increase the spread on the core trade to 5 points, which is what this example is. And then I can do 1 short and 4 longs, and I still have a solid credit of about $90, and a risk-free projection to the upside. If the market closes at 302, I'm not going to lose anything. And the problem is that when they placed this trade on, some stuff was going on in the market. Maybe an announcement was pending the following day. The FOMC meeting, maybe minutes were coming out on Wednesday, so they placed this trade on a Tuesday. The value of these options are extremely high. The projection does not account for the volatility that's going to be sucked out of these options as soon as those FOMC meeting minutes come out, right? So this is a situation. They put the graph together and then they don't understand how all of this works, and they just rely on the graph and they say, oh man, risk free, I'm going to put on 10 of these bad boys. And then nothing, they're not able to do anything. And in fact, on Wednesday, they're planning on selling a 302 call option for like $2 or whatever, if the market moves up there. And it does move up there, but it's only after the FOMC meeting, and the 302s are only worth 75 cents. Well, now they're not doing anything. And guess what? The volatility is coming out of the longs, and you know what it might actually look like? Well, this is where you can prepare, and you can use PDS Trader. This is a PDS Trader graph, by the way, so I strongly encourage you to take advantage of the PDS Trader tool when you're looking at these trades, because it allows you to do a lot of things to help you make sure you're doing it right and you're not overlooking something. All right, so the volatility is listed in each of the legs when you create a risk graph in PDS Trader. And here the volatility is showing at 0.11 on a Monday expiration option. Well, that volatility is as of right now. It is not telling you what the volatility is going to be on Friday because it doesn't know. Simple as that. It does not know. It's showing you volatility based on the circumstances that exist right now and the price of the option that exists right now. And let's say the FOMC meeting comes out, minutes come out, tomorrow you're going to see this number drop before your eyes. And this trade will go from looking like a risk-free projection trade, so you put 10 of them on, to losing maybe as much as $100, $125 in a worst-case scenario. And you put 10 of them on. Don't want to do that. So what I do is I change the volatility number. We've made this very specific because of this situation. You change the volatility number to a 0.08. That's more typical of what you're going to see on Friday at the close with regard to a Monday expiration option. And it might be even lower than that. And sometimes it's not going to be at 0.11 or 0.10. It's going to be at 0.08. And if it is already at 0.08, I would drop it to 0.07 just to find out the possible risk if volatility does drop even more by the time Friday expiration rolls around. This will keep you out of a lot of stupid trades by doing this. And so you just have to be aware, again, how all this stuff works. This is why I teach this stuff instead of just saying, hey, do this and you'll be fine. No, there are different situations, and it's really important that you understand them. So that's the process of what I do is I stress test the volatility. Say, okay, this looks great now, but what if volatility is different by the time I exit this trade and I'm not able to do anything to lower the risks, right? And this is what happens. Now, I'm not going to put this trade on ever, if it looks like this, because I have to do a lot in order to mitigate that risk. And the less I have to do, the higher the probability I have of being profitable with this approach. All right, so cautions. Risks, that's the first one. One of the ways to also mitigate that is to keep as few longs on as possible with regard to the number of shorts. But always understand that if you put on even if you put on a seven shorts and 8 longs, and it's showing $100 as the maximum risk, your 8 longs could be wrong. And if it's only wrong, if the projection is only wrong by 10 cents per long, you're talking about an 80-cent difference, almost double what your projection is. And that's just on a small error in the projected value of the long. So the fewer longs, the better when you put on these initial core trades. Second of all, you do not place on a core trade without a plan for steps 2 and 3, and you go through that plan before it ever happens. All right, so you say, okay, and again, you can do this with PDS Trader. You can say, okay, what if I exit one of my shorts at a 50-cent profit? And you can put that into PDS Trader, and it will show you the new risk graph. And then you can say, okay, what if that happens and volatility drops? And so you can change the volatility and say, oh, wow, I probably need to exit at a $60 profit or a $70 profit and not a $50 profit, or whatever the case is. Again, I'll go more into that in the following lessons. So you want to change that within your plan, and you plan out the whole trade. All right, and again, we'll go through that. And then finally, I do not want to wait until the last minute to get out of the core trade, if at all possible. The last hour of trading on Friday sees a significant drop in the value of the longs, especially if the market dies going into the close on Friday. So if I've secured a majority of my profit on Friday morning, I will get out of the whole thing on Friday morning. If I'm right at the worst possible loss, or whatever the case is, that's probably only going to get worse as the day moves on, unless the market moves away from that zone. At worst case scenario, because you do, so for example, if I am short a 300 call and the whole graph is based on that call being worthless, then I probably have to hold on to the trade until right before the close to get the most value out of that particular short. Just understand that the longs are also going to start to devalue pretty quickly after around 3 o'clock on a Friday. Okay, so generally, if I can, I will get out of a trade. I don't wait until the last minute to get out of a core trade. And again, you'll see this worked out practically as we move forward. All right. So that is lesson 1. I hope that it's a solid start for you, and I'll see you in lesson 2.